Luke Stein here, and this video is going to provide a little bit more detail about our second key financial statement, which is the income statement. So the income statement, which is also called the profit and loss statement, and therefore abbreviated IS or P&L, is going to measure the amount of profit that a firm has generated over a given period of time, which is usually a fiscal year or a fiscal quarter. So unlike the balance sheet, which tracks stocks or quantities as of a point in time, and the end of a year is also the end of a quarter, the income statement is going to cover flows over a period of time. So we really need to know how long that period is. And as I said, usually it's either going to be a year or a quarter. The income statement for a full fiscal year is just going to be the sum of the income statements for each of the 4 quarters that make that year up. So what's on the income statement? Well, up at the top is going to be revenue. That's the money that the firm's brought in by actually selling stuff in the course of business. And then we're going to subtract, as we go line by line through the income statement, various kinds of expenses. So there may be more than the ones that are listed on this slide, but big categories include cost of goods sold. So that's expenses that the firm has incurred in terms of actually producing the thing that it sells. You can think of these as being the costs that are most closely related to the sale. Also selling expenses. So the cost of actually getting customers to buy this thing. General and administrative expenses, the costs of running the business in a broader sense. Firms that engage in R&D, it's not listed on the slide, but may also expense their research and development costs. Then depreciation and amortization. So we talked about D&A when we talked about the balance sheet, and we noted that property, plant, and equipment or long-term assets are recorded on the balance sheet initially at the price that the firm paid for them, but then the accounting rules recognize that that stuff is likely to decline in value over time as it gets used up. So on the income statement, we're going to track that depreciation and amortization. It's kind of an accounting-based approximation of the amount by which the value of those long-term assets are declining over time. And that's an expense that the firm incurs in the course of doing business. Then we're going to have some sort of non-operating or further from operating expenses, including interest expense. So that's interest that the firm owes to anyone who's lent it money, which is typically going to be providers of debt finance. And then finally, income tax that the firm owes. So what's left? Well, if we take revenue at the top line and then we subtract off all the different categories of expenses, what's left at the bottom is profit. And that has some other names. It's called net income. It's called earnings. And those basically all refer to the same thing. So the income statement is going to have revenue minus expenses equals profits. That's kind of the key accounting identity that defines the income statement. And there's sort of sometimes interim versions where as we move down from the top line of revenues, we're going to subtract out expenses one by one. And sometimes we'll just sort of pause along the way and check where we're at. We're not yet at the bottom line of profits or earnings, but we'll see how much is left after certain categories of expenses have already been subtracted. So if we just subtract out COGS, we're going to get one measure of sort of interim measure of income or profit. If we subtract out COGS and SG&A, we're going to get a smaller number. If we also subtract out D&A, we're going to get an even smaller number. And as we work our way down, subtracting additional expenses, we're going to get sort of smaller and smaller measures of the firm's profit, ending with actual profit, net income or earnings that we often call the bottom line. So here's what kind of a typical income statement for a firm might look like, laid out algebraically. So we've got net revenues or sales at the top. And then as I mentioned, we're going to subtract various categories of expenses, maybe pausing along the way to get interim profit measures. And kind of the order in which we subtract those different categories of expenses generally tracks from expenses that are incurred very, very directly in the course of doing business down to ones that are a little bit more distant from the firm's key operations. So the first thing we're going to subtract is called cost of goods sold or COGS. These aren't always variable cost, but they're often in an economic sense, what we would think of as sort of the most highly variable cost, meaning the more stuff the firm sells, the more COGS they're likely to incur. So COGS or cost of goods sold gets subtracted out first. It's really, really integral to the firm's main line of business. And then whatever's left after we subtract out just that category of expenses is called gross income or gross profit. Okay, then we move a little bit further away from the firm's key operations and we subtract out costs associated with actually getting these products into the hands of customers, getting people to buy them, as well as the cost of running the firm in a general sense. So those are called SG&A or selling, general and administrative expenses, sometimes talked about separately as S, which is a little bit more close to getting business done, versus G&A, which is a little bit more kind of overhead style and more likely to be fixed, whereas selling costs are more likely to be variable. But often they get combined, and you'll see these called SG&A. We also then could subtract out for firms that engage in R&D or research and development. That's money that, in a sense, is being invested because they pay that money up front in order to try to develop new products that they're going to sell later. And so that's also going to get subtracted up in this category. Only some firms engage in R&D, and only some of the firms that engage in R&D actually include it as a separate line on their income statement. So now we've taken revenue and we've subtracted out COGS. We've also subtracted out SG&A and R&D. And what we're left with goes by the mouthful of a name: earnings before interest, taxes, depreciation, and amortization, abbreviated as EBITDA. So anytime you see an EB, that's earnings before, and then all the stuff that's listed afterwards tells you what's left to be subtracted out lower down on the income statement. EBITDA, we have not yet subtracted out interest, taxes, depreciation, or amortization. Okay, so we take EBITDA, we subtract out depreciation and amortization expense. So again, that's some accounting estimate or rules-based accounting estimate of how much the firm's property, plant, and equipment, their long-term assets, are declining in value over the course of the year, maybe because they're getting worn out and used up, maybe just because they're kind of getting old and less sort of modern or useful. After we subtract out D&A, we're left with earnings before interest and taxes. So we had EBITDA, and then we subtracted out D&A, we're left with EBIT, which is approximately equal to, not always exactly equal to, an accounting quantity that you'll see referred to as operating income. And the reason that's called operating income is you might think that COGS, SG&A, R&D, and D&A are all sort of operating expenses. The reason the firm has to pay for all that stuff is because they're operating their business. They're actually, making a good and service, a good or service, and selling it. And that's why they've incurred those expenses. So what's left? EBIT, what's left is interest and taxes. And interest is not paid because the firm is engaged in their operations of making and selling. Interest expense is incurred because they've borrowed money on the financial markets. So interest expense gets subtracted below. We hit that interim operating income measure. Interest expense gets paid to lenders, and typically those are financial lenders. Maybe they're going to have some kind of other stuff, which is non-operating, although this is kind of a weird thing that only some firms have. And so what's going to be left is EBT, or earnings before taxes. So now we've paid employees, we've paid suppliers, we've paid for capital goods, property, plant, and equipment, we've paid research scientists, we've paid salespeople, we've paid executives to do general and administrative stuff, we've paid everybody, including the debt financiers, except we haven't paid the government. So this EBT, earnings before tax measure, also called pre-tax income or taxable income, and you'll see it abbreviated any of those three ways: EBT, PTI, or sometimes TI for taxable income. The firm's going to have to calculate a tax bill off of that number, and once they've paid taxes, what's left is net income, also known as earnings or profit. So this stuff is going to get calculated for the whole firm as a whole, and that's what lies at the top and the bottom of the firm's income statement. But sometimes also we'll take some of these numbers, and in particular the bottom line number or net income, and shareholders in particular may be interested in understanding how big their stake in that is. So they'll divide that net income number by the number of shares that the firm has outstanding in order to know, well, for each share that they own, how much of that earnings is theirs. And that number is called EPS, or earnings per share. So what can the firm do with those earnings, that net income, that bottom line on the income statement? Well, as I alluded to on the last slide, that money belongs to the shareholders. The shareholders own the firm. And by the time we calculate net income, everybody other than the shareholders has been paid. Folks have been paid through COGS, through SG&A, and in particular debt financiers have been paid their interest expense. So money that's left in the bottom line, that net income, it belongs to the shareholders. And so what can the firm do with it? Well, they can do two and only two things. This is a mathematical accounting identity. It's not a question of maybe there's some other stuff they choose not to do. By definition, there's only two things that the firm can do with that net income, which belongs to the shareholders. Even they can give it to the shareholders now, which is called paying dividends, or they can reinvest that money in the firm on the shareholders' behalf. They can leave it inside the firm in order to try to earn additional profits for the shareholders in the future. So as an accounting identity, net income is going to equal dividends plus reinvestment. Those are the only two things that can be done with net income. They both benefit the shareholders. Paying dividends benefits the shareholders in the short term because they get cash in their pockets. Reinvesting in the firm hopefully benefits the shareholders in the long term because the firm has a greater ability to try to earn future profits and therefore increase in value. So, this is a discussion of the income statement, but you can sort of start to think about how the income statement connects to the balance sheet, and we'll have more to say about that connection when we talk about cash flow statements. So kind of where are these two choices that the firm could make in terms of what to do with net income on the balance sheet? Well, net income, I said, belongs to the shareholders. So where does it live on the right-hand side of the balance sheet? It lives in the lower right-hand corner. It lives in the shareholders' equity piece of the balance sheet. Okay, so if we think about a balance sheet with assets over here and liabilities up here and shareholders' equity down here, the net income initially lies down here in the shareholders' equity piece. So if the firm chooses to pay dividends, that means it's got to send cash in the mail by electronic funds transfer, whatever it is, to the shareholders, which means the firm's cash balance is going to decrease. Okay, cash is an asset. So the asset balance is going to go down and the balance sheet has to continue to balance. So when the firm sends those dividends out, it's going to reduce the size of the equity that the shareholders have in the firm. So net income is going to drive equity up for the firm. If it pays dividends, that equity is going to get driven back down by taking cash off the firm's balance sheet. If the firm reinvests, that equity stays in the equity side of the balance sheet. It's grown the equity side of the balance sheet. The right-hand side of the balance sheet is getting bigger. So in order to keep the balance sheet in balance, that reinvestment is going to have to get used either to increase the size of the left-hand side of the balance sheet. So equity goes up, the firm's been profitable. If it reinvests that, shareholders are going to have more equity in the firm and they can grow the asset side of the balance sheet, perhaps by expanding operations, buying new long-term assets, increasing inventory, holding more cash. The other thing the firm can do to maintain balance is increase equity, but do that reinvestment in the firm by decreasing liabilities. So it could use some of that increase in shareholders' equity that comes from the firm's net income in order to pay back some of the debt holders who've invested in the firm by lending it money. And sometimes that's called deleveraging the firm. Okay, so last thing we'll look at is an example of a balance sheet. This is for the same firm, H.J. Boswell, that we saw two balance sheets for before. Sorry, this is the income statement for Boswell. So what are we seeing? Well, we're getting an income statement for the year ending December 31st, 2013. So that's the fiscal year in question here. And everything we're told is expressed in millions of dollars. So the balance sheet has to start with sales. That's the top line of the balance sheet. The balance sheet has to end with net income or earnings or profit. That's the bottom line of the balance sheet. And then you'll notice that there's some extra stuff down here. And in fact, it's fairly common for the income statement to list sort of supplementary information at the bottom. And if I called this the balance sheet a minute ago, I misspoke and I apologize. So clearly this is the income statement. It starts with sales, it ends with net income, and everything below the net income line is sort of supplementary information. So Boswell had $2.7 billion in sales over the year ending December 31st, 2013. Of that $2.7 billion, they spent just over $2 billion actually acquiring inputs or on direct production costs to make whatever it is that Boswell sold. So that leaves them with gross profit of $675. That's kind of that interim subtraction. And whenever you see numbers on any accounting statement with parentheses around them, that just means they're negative numbers or they're getting subtracted. So Boswell's got $675 million left over after paying to produce the things that it sells. But there's other stuff they have to spend on. So there's other expenses they incur. In order to sell that $2.7 billion worth of stuff, they spent $90 million on sales expenses. They spent $67.5 million running the business and paying administrative and general expenses. And they used a whole bunch of property, plant, and equipment, long-term physical capital, which, according to the accountants, may have declined in value, or they may have kind of used up about $135 million worth of that stuff. So if we take sales at the top and we've now subtracted off COGS to get gross profit, and we subtract off SG&A and D&A, what we're left with is the $382.5 million of EBIT, or earnings before interest and taxes, also known as net operating income, and that's left. So is everybody paid? That goes to the shareholders? No, because it turns out Boswell also has borrowed some money from somebody. They owe interest on some of their liabilities. And so in 2013, they had to pay $67.5 million in interest to lenders. Okay, that leaves them $315 million in EBT, earnings before taxes, or PTI, pre-tax income, on which it turns out they had to pay $110.25 million in corporate income taxes, which left them net income of $204.75 million. So that's their net income. That's Boswell's bottom line. And what could they do with that 204.75? Well, as I mentioned on the last slide, there's two and only two things that they can do with that 204.75. It's either got to go to pay dividends, or it's got to get reinvested in the firm, in which case it's going to show up as an increase in retained earnings on the equity side of the balance sheet. So then we have this supplementary information down at the bottom of the balance sheet that's going to help us figure out a little bit about how they made that split. So we're told in this additional information that in calendar 2013, or fiscal 2013, which are the same for Boswell, they paid $45 million in dividends to shareholders during that year. So the firm made $205 million. Shareholders took $45 million of that as cash in that year. We've got another piece of supplementary information, which is that Boswell had 90 million shares of stock outstanding. And since they have to pay the same dividend to every shareholder per share that they own, if they paid $45 million in dividends and they had 90 million shares outstanding, that means that they paid dividends per share of 50 cents per share. So if you were a shareholder in Boswell, for every share that you owned, you should have gotten paid a 50-cent dividend in that year. You owned one share, you got 50 cents. You owned 100 shares, you got $50. You owned all 90 million shares. You're the sole owner of Boswell. You would have received 90 million shares times 50 cents per share. You would have received all $45 million would have been yours if you were the sole owner of the firm. So if Boswell earned $204.75 million, and that belongs to the shareholders, and they paid out $45 million of it to the shareholders in that year, that means that the remaining 204.75 minus $45 million that they paid out must be the amount that they reinvested in the firm that year. And we should be able to see that as the increase in retained earnings from the 2012 to the 2013 balance sheet for Boswell.